We think it's the demise of the central banks. After all, they're not permanent institutions. The Fed's about 100 years old. It's a baby. Especially over the last 50 years, it's created nothing but boom-bust cycles. Well, the problem now is the bust that they're creating is a bubble that is the biggest stock market bubble in U.S. market history. That political support could abandon them. And also a public acceptance of non-fiat money, gold, silver, and perhaps even some cryptos. Stuff not issued by government could ascend in popularity and acceptability. Silver turned up via its what we call quarterly momentum, meaning we measure the price of silver in relation to its three-quarter moving average. On a momentum chart, it broke out 5 or 6 weeks ago when it came up through the low 24s. Okay, its initial shot took it over 27, and it pulled back down into the low 24s again and sat on that support, and now we're back in the low 25s. We've got some numbers above that are on a larger time scale. In fact, it's a 200-week momentum chart. Okay, it's like a 4-year average. It has a structure such that if you get back up anywhere in the high 26s again, it says, okay, I'm engaging as well. It looks very right to do so. I don't think resistance, which is pretty obvious on a price chart. When you look at a price chart, you'll see there's a zone from $28 to $30 where the high weekly closes were, either side of 28, and a couple high trades. This is back in 2020 and early 21. I don't think it's going to be an effort to get through that stuff. The issue is getting up to it. And I think once you get up to it, you're going to zap through it quickly. And I think the tone in silver will change dramatically. And so right now, if I put a new number on silver that would say, okay, we're not only positive now, basis quarterly momentum, but we're going to engage the 4-year average structure, which is already positive. It's a secondary buy structure. It's hard to explain. Anyway, you get in the upper 26s again. You don't even have to get back to that high we made in early March. You get upper 26s, underside of 27, you should be back to the highs very rapidly, back to that $30 range. And that should not be resistance. And I think once you clear that on the price chart basis, that's when you're going to have a lot of people who are on the sidelines say, oh, I better be in this. Because it's bleeding obvious when you look at the price chart. We go through that 30 level, it's a launch. But our numbers just below 27 right now should really engage you. The gold and silver mining sector is a little teeny dot. If you have any movement at all, no wonder it's so strong, because if it gets chased by asset managers who want to move a couple percent out of the stock market into the gold and silver mining area, it'll goose that market up sharply. And that, I think, is what you're starting to see now, is very rapid rise. I mean, we were $28 on and change on GDX back in late last year, the end of last year. It's traded over 40 today. Okay, in a matter of 3 months or so. Boom. And most of that, a good chunk of that, occurred in the last 4 or 5 weeks. So yes, you're absolutely right. That's one reason we tend to like the miners, because we know fundamentally, though we don't assess them that way, we're technicians, that the mining group is extremely profitable by any normal metric and undervalued. Well, there's one on gold, but it's a price-based one, because frankly, momentum says I'm free to go. I'm going. And that's why we're not trading in the 1700s or the 1800s. We're trading in the middle 1900s right now, okay? If you do a point and figure chart, and if you know what a point and figure chart is, little X's and O's, okay? Well, if you do a $50 point and figure where every X or O is a $50 uptick or downtick, and you put it on a 3-block reversal, meaning you don't acknowledge a downtick unless there's at least 3 of them. And once you get the downticks, you don't put in the upticks unless there's 3 of them, meaning a $150 move. Okay, well, gold hit 2050, summer 2020, backed off into the below 1700 even. Did a lot of work. Came back up at 2050 in March, and fortunately it dropped back to 1900, allowing us to put in a down circle, a down circle, and a down circle, leaving what? 2 columns of X's that both peaked at the same level, 2050. Okay, now if you put upticks again on the board, 1950, 2000, 2050, you're at a triple top. And don't let that word top fool you. You're probably at a triple top breakout, because when you hit 2100, that is a triple top breakout. And that should excite the price guys like crazy. So anybody who's sitting and waiting for gold to amply clear the 2020 high, the year 2020, price was 2070. You hit 2100 and it's just open sky. So we think returning to the top tick one more time is highly likely to be a launch point, meaning a point at which not only gold goes up, but it goes up in a rate that you're not used to seeing. You know, not 10 or 20 bucks a day, but you might get $1,500 days mixed in there. So watch that. And there's some economists who are aware of that, particularly the Austrian school, where, you know, they go through this lowering rates below reality, increasing the supply of money. It generates a stock market boom and, quote, economic boom. A lot of false indicators there. But when the stock market turns down and the economic data points turn down, what do? You know, they have to go back to printing more, you know, because they try to tighten here and there and they create busts. Well, the problem now is the bust that they're creating is a bubble that is the biggest stock market bubble in U.S. market history on a percentage basis and on time basis. We've gone up for a dozen years plus, and you've gone up percentages in an angle of ascent that can't be matched by any other prior bull market, including 1920s or the 2000 dot-com bubble or the 2007 peak. They're minuscule compared to what the Fed has created over the last dozen years via all kinds of tools like QEs and so forth. They now have a problem that their bubble, they won't call it their bubble, but it is. When it comes unwound and they help provoke it, stick a pen in it. We call it sticking a saber in it in the weekend report. And it starts to come unwind, and they got a problem because that won't just be a market downturn. That will be a public sentiment downturn. It'll be a corporate policy downturn. Corporate spending will change. A lot of things will change. And all their economic numbers that they like to point to as being strong will suddenly go reverse. And they'll be sitting there raising rates in that environment. They'll lose all credibility. And if they switch back to another policy, the normal policy, to defend these assets, which won't work, never does in bear markets. They always defend bear markets and it never stops them. They'll lose public acceptance. Academicians will say, hey, they make no sense. They flip-flop every other year. You know, it's chaos. They don't know what they're doing. And it wouldn't surprise us that in this crisis that we're about to move into, that the central banks come into question as to whether they continue. That political support could abandon them. And also a public acceptance of non-fiat money, gold, silver, and perhaps even some cryptos. Stuff not issued by government could ascend in popularity and acceptability.